The Fed chief, Jerome Powell's uncompromising remarks on inflation on Friday have sent jitters to financial markets, leading to heavy investment losses. His comments at Jackson Hole reignited fears of a recession in the United States. The Fed chair telling the annual central bankers conference that the Fed will continue to raise interest rates and keep them raised in a bid to combat inflation. He said taming price rises will be painful for US citizens and businesses. Stock markets across the world were down immediately after the speech. Moreover, America's financial elites lost close to $78 billion over the weekend.
The burdens of high inflation fall heaviest on those who are least able to bear them. Restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain.
The Fed has hiked interest rates, of course, 4 times this year, and Jerome Powell indicated more substantial interest rate rises could be on the cards in the coming month. We're joined for more on all of this by Daniel Geltrude, a business analyst from Nutley in New Jersey. Mr. Geltrude, thanks so much for being with us here on WION. This was a pretty mixed message that Jerome Powell presented for the financial markets, and many traders have chosen to interpret it negatively, but it does indicate, doesn't it, that the Fed is still very focused on the threat of inflation that, of course, Jerome Powell a year ago was among officials sort of waving away and indicating that he didn't think was a substantial risk to the country.
Well, he's certainly done a 180 since he first began to talk about inflation being transitory. And as we know, inflation is not transitory. If you look at what Jerome Powell said and you substitute the word pain for recession and stagflation, because that's what he was saying, the pain that we're going to experience, this economic pain, is going to come in the form of a recession as well as stagflation. And it's not going to end anytime soon because the Fed is looking to take down inflation as its primary goal. With that said, they're going to continue to raise interest rates until we get to a point where inflation is around 2%. We're a long way away from that. So to me, that means we're looking at potentially a very long and deep recession over the next year, 2 years, maybe longer.
So, Mr. Geltrude, it's your position then that this is a recession that the United States is facing, even though the Biden administration doesn't want to call it one?
Absolutely. By definition, we're already in a recession, and there's no doubt in my mind that it is not going to get better. The other thing that Jerome Powell said was bringing supply and demand into balance. So if we look at that as a scale, right, and we're out of balance right now, meaning that there's a lot of demand and not enough supply, the Fed is looking at this and saying, well, we have to take down demand. My position is, let's focus in on supply. That's a lot less painful. So if demand is high, that's not a bad thing as long as the supply chains are there to provide the goods and services that people want and people need. Supply side of the equation is addressed through policy. And I think right now, specifically energy policy in the United States is what's hurting the supply chains. Fix that and we'll have less pain in getting to equilibrium.
Interesting months ahead. Daniel Geltrude, business analyst from New Jersey. I hope you'll join us on the programme again. Thanks very much indeed for being with us today.
Thank you.